If you've been watching the charts over the last 48 hours, you've probably felt that pressure drop. We just saw one of the fastest, most high-velocity corrections of the year.
It was a shock to the system.
A huge shock. Bitcoin, which felt like it was on this steady, relentless climb, just slammed into a liquidity wall. But here's the paradox, and this is what we need to really dissect today. While the price action screamed panic, forced selling, the long-term stuff, the corporate strategy, regulatory clarity, even institutional products, well, they've never looked stronger.
That's the conflict right there. That is the defining tension of this moment, and that's what our deep dive is all about today. We're trying to look past the scary red candles and see the tectonic shifts underneath.
So what's the mission?
Well, the mission is to hit the three critical pressure points. First, the technical breakdown of the price, which led to that big institutional retreat. Second, the really high-stakes game that players like MicroStrategy are in.
Right, the buy wall versus the index risk.
Exactly. And finally, the regulatory pivot that kind of came out of nowhere and gave the market the clarity it's been begging for years.
So it's a decoupling. It's happening in real time. Price is down because of macro risk, but institutional confidence and the actual rules of the game are, well, they're unequivocally up. You have to understand both to get where we're going. Okay, so let's start with the pain, because it was sharp. We're calling this the Bitcoin $82,000 liquidity test.
It was a test, for sure.
BTC dropped around 7% in a single day, and crucially, it blew right through the $86,000 technical floor.
And that $86,000 level, wasn't just a random line on a chart. That was the aggregate cost basis, basically the average entry price for a few huge institutional groups that got in earlier this year.
So when the price goes below their average cost?
Their automated selling protocols kick in. And those things, they don't wait for confirmation. They just sell.
So that floor broke, and it just opened the floodgates. The price found a little bit of support, I guess, barely holding around 82 to 83,000. But the technicals, they still look pretty concerning.
They do. We're seeing major red flags. I mean, sure, it's technically oversold on indicators like the RSI, but the big psychological hit is the death cross.
Okay, for anyone who doesn't live in the charts, what is the death cross?
It's when the 50-day moving average crosses below the 200-day moving average. It's a classic signal.
And what does that signal to the high-speed trading desks, the algos?
It signals a major long-term bearish trend reversal. Now, it's a noisy signal, I'll grant you that, but it becomes a self-fulfilling prophecy because so many algorithms are just programmed to react to it.
So if this $82,000 support fails,
then the next major support level is it's a lot lower. We're talking somewhere between $73,000 and $75,000.
and this whole thing was just fueled by leveraged positions getting completely wiped out. The liquidation cascade was historic. Over $2 billion in liquidations in 24 hours.
And that's the mechanic right there. That's what turns a small correction into a crash.
Yeah.
When you get liquidated, it's forced selling. You don't get a choice.
Yeah.
And all that volume, almost all of it from longs, created a vicious feedback loop. It just dumped collateral onto really thin order books.
Which is why the drop looked almost vertical.
Exactly.
And that leads us straight to the main driver here.
Yeah.
The ETF outflow crisis. This wasn't just retail getting scared. The biggest players in traditional finance were heading for the door.
Absolutely. The U.S. spot Bitcoin ETFs, like BlackRock's IBIT, which has been this unstoppable giant, they saw a massive retreat. On November 21st alone, a net outflow of $903 million.
Wow.
And that was after a $523 million outflow from IBIT just the day before.
That is serious capital flight. What's driving it? Is it a crypto-specific panic, or is this a bigger macro story?
It's almost entirely macro. This outflow correlates perfectly with rising U.S. Treasury yields and a stronger dollar. When that happens, the big traditional allocators, they go risk off.
Meaning they sell their high-risk assets like Bitcoin.
Exactly. They rotate out of high beta assets, so Bitcoin growth tech stocks, and they move money back into safer things like bonds. They're basically giving up hope that the Fed is going to cut rates anytime soon.
And the mechanical impact of those VTF outflows is huge, isn't it?
Oh, it can't be overstated. It is a direct mechanical pressure. When an investor sells their ETF shares, the issuer, BlackRock, Fidelity, whoever, is forced to sell the actual Bitcoin on the spot market to give the investor their cash back.
So $900 million in outflows means $900 million in forced selling.
Precisely. Adding hundreds of millions in selling pressure, just accelerating the whole thing.
What's really fascinating about this moment, though, is the decoupling from tech. I mean, NVIDIA posted incredible numbers, $57 billion in Q3 revenue, 62% year-over-year growth.
Unbelievable numbers.
And in the past, that would have pulled crypto up with it. The two were always seen as, correlated risk assets.
That correlation, what people call the AI crypto trade, it seems to be definitively breaking down. Investors are isolating their risks now. They're treating crypto volatility as its own thing, driven by its own internal mechanics, not just as a proxy for the tech sector.
Which is a sign of maturity, I guess, even if it's painful.
It is. I mean, even Binance's CEO, Richard Teng, called this a healthy consolidation. He said it was needed to flush out all that excess leverage.
And he has a point. I mean, you have to put it in context. Bitcoin is still trading at roughly double where it started the year.
Right, so let's pivot to the MicroStrategy paradox, because this is where the story gets really, really interesting. While the market was in a free fall, MSTR was out there making one of its most aggressive moves yet.
It's peak MSTR bravado, isn't it? They just completed an upsized $3 billion convertible senior note offering. Can you break that down for us? What is that, and why does it matter so much?
Absolutely. So a convertible note is basically debt that can be turned into company stock later on. And this one was a 0% coupon, meaning no interest payments, with a 55% conversion premium.
Which is a huge vote of confidence.
A massive vote of confidence from very sophisticated investors. They're betting the stock price is going to go way up, making that conversion incredibly profitable for them down the line.
So the key isn't the debt itself, it's what MicroStrategy is going to do with that $3 billion in cash.
That's it, exactly. That $3 billion is explicitly for buying more Bitcoin. This creates a massive $3 billion buy wall that they can deploy right now during this correction. They are setting themselves up to be the ultimate buyer of last resort.
So that's the bullish anchor. That's the thing holding up the long-term confidence argument. But you can't talk about that buy wall without talking about the massive risk they're facing from JP Morgan and MSCI.
And that risk is almost existential for their stock price. JP Morgan analysts put out a really stark warning. They said MSTR is facing a potential exclusion from major equity indices, specifically the MSCI USA.
And being an index is one of those boring things that is suddenly everything. Why are they at risk?
Well, MSCI, which is Morgan Stanley Capital International, they're looking at new rules. And these rules could exclude companies where digital assets make up more than 50% of their total assets.
Which, for MicroStrategy, that's their entire business model.
It is. They are way past that 50% line.
So if they get kicked out of the MSCI USA index, what actually happens?
It triggers automatic forced selling by passive funds. The big index tracking funds that just mirror the index, they would have no choice but to liquidate all their MSTR stock. JP Morgan thinks this could trigger anywhere from $2.8 billion up to $8.8 billion in forced selling.
Wait, hold on. So you have a $3 billion company buy wall for Bitcoin facing a potential $8.8 billion forced sell-off of its own stock.
It is the highest stakes corporate tightrope walk I think we've ever seen in this space.
That would just crush the stock's premium over its net asset value, its NAV.
It would evaporate overnight. That premium exists because of that easy institutional access. If $8 billion worth of selling hits the market, that premium is gone.
Okay, so beyond the MSTR drama, the institutional product landscape is still moving forward, which signals confidence.
It's accelerating. I mean, look at 21 Shares. They just launched a 2x long Dogecoin ETF, TXXD. This is not for your average investor. This is a high beta derivative for sophisticated traders. It shows the derivatives market is maturing way beyond just Bitcoin and Ether.
And the race for the next big spot ETF is on. Bitwise just officially filed for a Spot Solana ETF.
Yep, they're joining VanEck and 21 Shares. And that signals a clear consensus among the big asset managers.
What's the consensus?
They are betting big and spending a lot on legal fees. That we're heading for a more permissive regulatory environment for assets other than Bitcoin in 2026. You don't file this stuff unless you think there's a clear path forward with the SEC.
And speaking of TradFi, Charles Schwab, which has 46 million clients, just bought Forge Global.
That's a huge strategic move. Forge is a platform for trading private shares of companies, including crypto companies like Kraken and Ripple before they go public. This gives Schwab a direct foothold in the secondary market for digital asset equity,
potentially opening up pre-IPO crypto access to its massive client base.
The lines aren't just blurring anymore, they're merging completely.
Okay, so if the price is bleeding and the corporations are playing this high-stakes game of chicken, the regulatory side is actually providing some of the clearest signs of long-term health.
It really is. We're seeing a monumental shift here, starting with what the SEC is calling Project Crypto.
This is the policy pivot everyone's been waiting for. The new SEC chair, Paul Atkins, he laid out a new strategic direction. It's focused on a return to, core principles of investor protection.
And this is the crucial part, ensuring those principles don't stifle innovation. That has been the industry's biggest complaint for years.
And the key was in his language. He specifically said, and I'm quoting, investment contracts do not last forever. Let's unpack that because that's a massive deal.
It is a profound shift. It's the definitive end of the old regulation by enforcement era. What he's signaling is a potential pathway for tokens to actually shed their security status once a network becomes decentralized enough.
So something can start as a security and evolve into something else?
Exactly. It could become a commodity or a utility.
Yeah.
It gives developers and innovators the blueprint for compliance that they have been desperate for.
And that kind of clarity, that's what unlocks serious institutional capital, right?
Absolutely. If a big fund knows the risk of a token being retroactively declared an illegal security is going down, they can actually deploy capital with confidence.
And it's not just the SEC. We got operational clarity from the banking regulator, the OCC.
Yes, what we're calling the Trojan horse guidance. It's an interpretive letter. It sounds deceptively simple, but it's incredibly important.
Permit.
It explicitly allows national banks to hold and use cryptocurrency for one specific purpose.
Yeah.
Paying blockchain network fees, what we call gas.
Okay, so why is paying a transaction fee a Trojan horse for mass adoption? That sounds so minor.
Because to pay gas on a public chain like Ethereum or Solana, you have to hold the native asset, ETH or SOL. By allowing this, the OCC removed a huge compliance roadblock.
Oh.
It gives banks the green light to start building the actual operational infrastructure they need for things like tokenizing real-world assets or using stablecoins for settlement. They can now interact directly with public chains as builders, not just as speculators.
So we've established the long-term infrastructure is getting stronger, but the short-term pain is real across the entire market. The sell-off pushed the total crypto market cap back below that big psychological $3 trillion mark.
And you see the classic pattern here. The correlation between Bitcoin and the altcoins is still stubbornly high, over 0.85. When Bitcoin panics, everything sells off.
We saw heavy selling in assets like XRP, which dropped almost 9% to $1.91.
Right, and that volume spike on the way down, it tells you that large holders were using the liquidity from the panic to get out of their positions.
And Cardano, ADA, it's facing a real technical challenge. It lost its key 50-cent support level, which has now flipped into resistance.
And that's a really concerning technical signal. If it can't reclaim that level quickly, the model suggests the bearish trend could continue down towards the 35 or 40 cent range. There just isn't much buying pressure there right now.
But every crash has an outlier. And this time, it was Forta, ticker FORT. It surged over 56%, just completely defying the rest of the market.
And this highlights a really important trend I'm seeing, a flight to utility.
Yeah.
Forta is a decentralized security monitoring platform.
So it actually does something useful.
It solves a critical problem. Its surge was driven by new listings on Korean exchanges, but more importantly, by adoption of its security product, Firewall. Investors are starting to prioritize projects that solve the real, immediate security pain points that have plagued this industry all year.
Okay, so let's wrap this up. Let's bring it back to that core tension we started with. We saw a weekend of just extreme bearishness in the price, record EPF outflows, technical breakdowns.
But it was juxtaposed against this unprecedented push towards long-term structural stability.
That's the battleground. You have MicroStrategy, armed with $3 billion, creating this massive buy wall for Bitcoin.
But at the exact same time, they're staring down the barrel of a potential $8.8 billion in forced selling if MSCI changes its index rules because of their Bitcoin exposure.
So here's the final thought for you to consider as you watch the market unfold. Which force is going to win out? Is it the aggressive, intentional buying pressure from a corporate believer? Or is it the systematic, passive selling pressure required by institutional index rules?
That battle between corporate conviction and institutional mechanics is what's going to determine if $82,000 holds.